Okay, we're going to get started. We're going to look at the calendar. We're halfway through the year, or most of the way through the year. We're starting November, which is traditionally one of the best months of the year. Actually, April and November are the best months, seasonality wise. So we have a little bit of volatility now. So remember in the back of your mind, we're over, we're probably going to end the month pretty good. We have NVIDIA earnings out on the 19th of November. We have an election next week. The reason why the election is so important to the stock market is the stock market likes certainty. And if there is uncertainty in the market, people get jittery and they sell, and the stock market goes down. Um, let's hope that there's not a contested election. If we get a quick results for one candidate or the other, that will help the stock market. If there is a protracted election mess like there was in the past, and it goes out to January before we find a president, that could make the stock market go down. Next week, next week we have the Federal Reserve meeting talking about interest rates, and they're probably going to reduce the rates by a quarter point. And we have another meeting in December on the 17th and 18th. We have Christmas and Thanksgiving. Christmas and Thanksgiving are two of the most popular and look forward to holidays of the year. And because of that, people get excited and happy around that time. And also at that time, stock market likewise goes up. So that's doesn't happen all the time. Otherwise, we would all be millionaires. Okay, so seasonality works most of the time, but you can't count on it. Okay, so we had this week a lot of earnings reports coming out. We had Waste Management, Google, Visa. So Google came out with stellar earnings, um, and Visa they had good earnings. We had Microsoft. They had 30% growth in their cloud business, and that was but they're spending a lot, so that kind of affected the stock a little bit. Meta also had beat expectations, but just like Microsoft, but their spending got people a little bit nervous. AbbVie had good earnings, and Apple, they also had good earnings. Apple had a one problem where they had a fine in the European Union of $10 billion, and that really hurt their profitability this quarter, but that's only temporary. Amazon came out with really good earnings last night, and they went up 6% this today. MasterCard also with good earnings. So this is a probably the biggest consequential week in earnings that we've had so far this year because we had so many big tech stocks reporting. Um, and the tech stocks, the big 10 tech stocks are the Magnificent Seven. They are 30% of the stock market. Now, of the S&P. Now let's all right, so that's good to know. Let's look at our talking points. We are losing momentum in the stock market. Last week we had 60% of the S&P above the 50-day moving average. Now we only have 46%. Now you can click on these links if you get these. Um, right now we have 68% of the stock market is above the 200-day moving average. So we're losing momentum, and that corresponds with fear that's starting to come in the market. And um, okay, so let's look at for some of the catalysts for the market to go down. We have the 10-year Treasury going up a lot recently. That is going to really affect stocks if it continues its march up. Um, and we're continuing with our theme, the worst to first. Healthcare, telecom, financials, energies, and utilities did bad last year, and we expect them to do better this year. And okay, so we're coming up to right now we're in November and December, the best months of the year for the stock market. And seasonality wise, this is a good time. And in the stochastics of the stock market of the S&P, we're about halfway, 50%. Um, so we're basically in a nowhere's land right now. We're not oversold, we're not overbought. We're like halfway. And in that sense, that we don't buy or sell during this time. We're just kind of waiting for the market to play out. I think what's happening right now is people are waiting, marking time for the election. As soon as the election happens, then there's going to be a lot of selling or buying. Okay, so we still have, we're still keeping track of the two-year and the 10-year Treasury. Um, and our theory right now is as the 10-year Treasury and the 2-year Treasury go up, um, the stock market goes down. All right, so oil is unchanged since last week. We have a lot of global issues, but right now seems like that's not changing. Right now we have kind of a weak global economy, and America actually is exporting more oil than any other nation. So it seems like right now we have a lot of supply also in the market. But the important reason why we're keeping track of oil is oil has a great effect on inflation. It has an effect on every product that we buy because everything we buy somehow was transported by using oil or was made from oil, such as plastics. Okay, so let's look at fear and greed index. Just started into fear. So people are starting to get fearful in the stock market and people are buying protection. We had a little bit of a downward march in the stock market this week. Um, the AAII survey, people are equally bullish, neutral, and bearish. So we can't get anything from that. The VIX is getting higher, so it's up like 10%. Investors are getting more fearful. So this is kind of whenever this gets higher, the higher this gets, the more enticing it is to start buying because that's the opposite of what normal people were doing in the stock market. All right. So right now we're in our emotional graph. We're at fearful right now. And um, when we're at capitulation, that's the time to start buying things. Um, things where I'm concerned about for that lead to a stock market crash. The higher the treasury rates are, the United States might have problems paying that money back and might get into a crisis. So if that happens, we'll lose all kind of faith in our currency, and that could cause unknown ramifications. Um, okay, right now we had a big problem with one of the major stocks in the AI universe, Supermicro, SMCI. They had an inquiry into their accounting practices, and that could lead to a problem for the AI companies if there's accounting irregularities with one of the major builders of infrastructure for the data centers. Um, okay, so we'll keep an eye on that. Right now, it's not affecting other companies. Um, all right, so we might have to worry about Trump's action or words after he's president. We don't know. Let's look at first to worst. You can see that utilities was the worst last year. It ends up being one of the top three sectors of this year. Consumer staples is up 13%. That's pretty good compared to negative 3.8 last year. Energy has still underperformed. So if you bought energy, it's not really a good performer so far this year or in the past 5 years. One interesting thing about the energy sector is it pays larger dividends and it only grows like 5 or 10% a year traditionally. It's very similar to the car or the auto industry. Auto industries, they only go up, or I mean, they only grow their revenues 3% or 5%, 3%, 5%. Um, Healthcare is only at 7% this year so far, but you can see that communication services and tech are still the top performers this year. That's probably because they have the best earnings, and over time, they're going to most likely outperform. Um, okay, all right. Let's look at okay. Let's look at the sector ETFs. Okay, so we have a little cheat sheet here I included with our meeting notes. Okay, the cheat sheet is rising yields of the 10-year. If you have rising yields of the 10-year, which we do today. So we have the 10-year going up. This is just an amazing amount, 10 times what traditionally is a lot. So this due to the jobs report. Now, rising yields, we expect large caps tech stocks to do good because they don't have to borrow money. Financial sector is usually better. And insurers, because a lot of insurers, they have to hold lots of cash. So getting paid more for that short-term cash is going to help them. Now, it's negative for small caps because it raises their funding costs. High yielding stocks such as utilities and healthcare, home builders, because the price of the mortgage rates go up, so the price of um, a mortgage for your house goes up. So let's see if any of this happens today in our sectors. Ones that went down the most, utilities. Yes, that makes sense because, um, hold on. That makes sense because utilities, it's negative for high yielding stocks such as utilities because utilities pay a high dividend. And if you have a sure thing, US Treasury um, trading higher, then who's going to want to invest in something risky? Now we have miners. I'm not sure why gold is going up. Um, real estate. That goes with our theme of it's negative for real estate because the price of buying houses uh, and financing real estate goes up as interest rates go up. Demand for housing goes down. And real estate index fund, that makes sense. Um, okay, energy select sector. Okay, so we had a price of oil go down, I guess, today. That's why the energies are down today. Let's look at the ones going up the most. Biotech. Okay, that's strange because biotech um, needs to borrow money. These companies that are not profitable. So if the interest rates are going up, there's a chance that biotech won't be as profitable. Um, let's look at semiconductors. This goes with our rising yields are good for large cap tech stocks. So we expect to see a lot of large cap tech stocks. Um, technology sector fund, that makes sense, is the semiconductors. Those are all large cap tech stocks. And okay, healthcare. These actually pay a dividend. So all right, that kind of so you can see this through this exercise, the importance of the 10-year treasury and the importance of that and how it affects other of your other investments. Okay, so let's look at some of the market movers for today. The ones going up and down the most. Let me see. Charter Communications, they're doing a spin-off of their one of their units. Um, Intel, Amazon are large cap tech stocks, so they'll um, Amazon had good earnings today. That's why it's up. And Dell is up, maybe because they're one of their major competitors, Supermicro, is under scrutiny and they're going down 10, 30% a day. So they're up in sympathy. And okay, let's look at the ones going down the most. Supermicro, we already talked about that. The government is looking into their accounting practices. And a lot of energy stocks. These are data center utilities. Why are they down? Because let's look at our cheat sheet. High yields, rising yields are good for these, but are bad for utilities. Okay, so we definitely see that connection, and they are down big. I mean, these are down 3 to 10%. Wow. Okay, so that was a good little excursion. All right, let's get back to our talk. Okay, let's look at some of Dan Now's picks for the year. Okay, so we still have Amazon. It went up a lot today, 6 or 7% today. So it's up 30% this year. He was right on the money with Amazon and Meta. Um, Meta is still up 61%, and Texas Instruments up 14%. Small cap biotech was up a lot today. Oh no, it was up. It was down some today. So this is like the worst performing of all of his picks. KWeb is up 19%. So I can't wait for his next year's picks of the year. We're going to check those too. Okay, so this is just a reminder. I go over this like once or twice, once every month or two. Whenever you're investing, you gotta sometimes use some market timing to get into positions. And whenever you have a trending stock or index, trending means you can see it goes up and down, and you have well-defined top channel and bottom channel if you connect the dots for the bottoms and the tops. And the time not to buy is whenever the stochastics are high and you're at the top of a channel. The time to buy is whenever your stock chart is at the bottom of a channel and you're at the bottom of the stochastics. So let's look at a couple examples. I send this chart out every week of the indexes. Sometimes you have a lot of these sectors right now, like the S&P, we're halfway between overbought and oversold. You don't really do anything whenever that happens. But right now you can see there are sectors like the defense sector, you can see is at the bottom of its channel and it's super oversold. So so right now we have some in the defense world, we have some uncertainty regarding the next president. We don't know what kind of spending or budget the next president's going to have. Are they going to fund a war or not? And based on, I mean, right now this sector is out of favor and it's oversold, but this is the perfect time to buy if you are interested in that kind of sector. Let me see. Here's another one that's oversold. This is XLB materials sector. So we see that it's near the bottom of its channel and it's oversold. Let's look for some more possibilities here. What I'm looking at is this spot right here, which is XLP. This is Consumer Staple Select. It's oversold and it's at the bottom of its channel. So the reason why we follow these ETFs and the stocks is sometimes we have extra cash to invest. And whenever the sector such as the consumer staples is out of favor, people are selling and it's oversold, that's when whenever you want to start looking at a stock in that sector. For instance, consumer staples, you look at Procter and Gamble and it would probably have a similar chart. And that could help you time a buy right now if you're dollar costing into the market. Okay, so see if we now see any stocks that follow. Okay, so you can see Altria, you can see it's at the top of its range here and it's overbought. That's not a time to buy that. But let's look at this one. This is Apple. It's oversold and it's not even, it's halfway between overbought and oversold. So there's no signal there. Let's look at Colgate Palmolive. It's oversold. It's below 20 in the stochastics and it's near the bottom of the trading range. So let's look at some more examples. Here's one, Pepsi. This pays a dividend and it's a consumer staple stock. So it's pretty consistent and it's been in this sideways pattern for years. And so we're at the bottom of this channel and we're oversold. So as a contrarian, you could start buying this if you don't have, a dividend stock this has like appreciated around 10% a year for the past 20 or 30 years. So, but right now I have it in my portfolio for dividend. So, anyways, that's a good little excursion. Let's look at some more. Yeah, that explains our buy and sell stochastics mentality. Um, let's look at a quick review of how to balance what you buy and try to get different sectors. So, for instance, if you have a portfolio like this portfolio here, what you want to try to do is break down all the sectors in a spreadsheet. And you have to say what sector, for instance, Eli Lilly belongs in the healthcare sector. So um, you put the percentage of that stock, in that area, and then you can see how much in each of these sectors that you have as a percentage. And you want to try to get even, like a nice diverse portfolio with a good even amount in each of these. And that's a true portfolio that's diversified. Also, you have to keep in mind whether it's a growth stock or an income stock. So whenever you buy a stock, like when I buy Pepsi, let's say, look at Pepsi. Is it in here? Is it in here? No, PepsiCo. I treat that as a dividend stock because um, it pays a dividend and it doesn't grow very much. And so right now I have 25% of my money paying dividends. And as you get older, you want to have more in your money, more and more of your money in the fixed income or dividend paying instruments so that you can have a steady flow of income when you're retired. So, um, so over time, I'm going to move this 73% growth to like 70, 60 to 50% growth, 50% income. And I'll dollar cost into these positions as they present themselves. For instance, if PepsiCo dropped in half for some reason, I would start buying a little bit of that and as part of and then I would sell some of my growth. Over time, I want to get more into dividends, for instance. Okay, let's look at, I did a stock screen and I sorted by PEG ratio because we haven't done that for a while. PEG ratio is the price over earnings growth. So a lot of times the price, um, if you're growing at 10% a year, um, and your PE ratio is 10, then you have a fair value of 1. If you have a PEG ratio of less than 1, that's an indication that the stock is on sale. But you can see a lot of these stocks have warts. They have problems. They missed some earnings estimates. They had, um, we have super micro. They have accounting irregularities. And we have some companies like Coinbase that are being challenged, their business model. For instance, there's ETFs now that allow you to buy Bitcoin without buying the actual Bitcoin. So there's a lot of there's a reasons why these stocks are cheap. And part of doing research is you got to do your due diligence to find stocks that really have a good story that might be thrown out like the baby with the bathwater. So, but these are because I sort of by peg ratio, a lot of the big stocks aren't going to be in here. So they're not that interesting. So I'm gonna skip these for now. Okay, let's look at let's review what it takes to make a good growth stock. This is my specialty, investing in growth stocks. I and let's look at some of the formulas for purchase. This is how I do all my screening. I look for peg ratio, try to look for it under 1, and try to get a growth rate over 10. Market cap over 50 billion gives you a little more consistency. You have a profit margin over 12 and return on equity over 12. And try to limit the stocks that have a lot of debt. And there are exceptions, like banks, they have to borrow from people in order to lend to other people. So there's business models that are okay to have debt and are actually part of their business, um, such as, let's see, banks, what other companies? Well, that's an example. But there are companies like AT&T and Verizon that have a lot of debt that right now they're managing, but if it gets too much, they might have financial problems or they might not perform well. So let's look at other things. We want highly transparent and predictable growing earning streams. We want little or no debt and a dividend if possible. The company has to have a competitive edge. And that's it. Let's look at Hendershot Investments. This company manages money. Okay, they're a money manager. They're like and this lady studies Warren Buffett's methodology, and she like really likes following Warren Buffett's strategies. Um, so let's look at some, and she comes out with newsletters. You can get the newsletter on here, right here, this place. Um, and she updates it every 3 months. And so we have one from June we're going to go over now, just for fun. Her top holdings, as on our website, are Berkshire Hathaway. These are all stock. Most of these are stocks we're following. We looked at Booking Holdings has been in our screener forever, so maybe we'll look at this in another week. We see Johnson and Johnson we're following, and Alphabet and Microsoft. So the great thing about her newsletter is it gives you reasons why she's continuing to hold stocks and when she bought them. We'll go over that later. But these are the top holdings based on her 13F filed with the SEC. You can see that a lot of these are ones we're following too. These are stocks widely held by mutual funds and money managers like hedge funds. And the great thing about Ingrid is she buys and she holds and she consistently sticks with companies in their ups and downs and you can tell by her hold time she's held stocks for like 10, 15, 20 years and has made amazing gains and she follows the fundamentals and that's what I like to do. So our top holdings are Apple, Google, we have Microsoft, Oracle, Google, and Berkshire Hathaway. So a lot of the ones we're following, Eli Lilly, she recently added Eli Lilly and Nvidia. So whenever you see a smart lady like her investing in stocks that we're following, that gives you a little added comfort. Let's look at some of her notes from her magazine. Alphabet, she originally bought this in 2011, 13 years ago. Um, Recently, they initiated a dividend and announced a $70 billion share buyback program. She loves dividends and buybacks, and she'll highlight that all the time. Apple increased their dividend 4%, and they instantiated a $110 billion share buyback. Berkshire Hathaway, free cash flow up 24% to 6.4 billion, repurchased 2.6 billion in stock, and they invested in Chubb. All right, so these are examples, and you can see she bought her Berkshire in the year 2000, which is pretty amazing. Apple, she bought in 2010. She's a buy and hold person. Whenever she exits a position, then you got to really look at it because she knows her stuff. An interesting thing, her methodology of investing, she trims whenever a stock trades up to a fair value and it's a certain percentage of her portfolio, she trims it. So that's a good thing to start doing, if you have large positions. Um, let's look at some more. All right. Yeah, that was nice. All right, now let's look at stochastics charts. Okay, we're gonna look at some more examples of stocks that um, Procter and Gamble. Remember we were saying the XLP sector was at the same exact position. It's oversold and it's at the bottom of its channel. Now, an interesting thing about this is um, consumer staple stocks like Procter and Gamble do very good in times of economic uncertainty. And when there's stocks going down like crazy around in the stock market, this is a consistent stock that's going to be paying dividends. People are still going to buy Tide whenever there's a bad recession or bad economic times. Um, so this I've held this for like one of the longest holds of my portfolio. Um, so let's look at another stock here. This one is Starbucks. Okay, it's right in the middle of a CEO change, so there's a lot of waiting around to see how that goes before it goes up or down. Let's look at the Verizon. You can see that this is oversold. It's below 10 and it's at the bottom of its channel. Let's look at this was Visa. Visa's on a tear. It's doing well. It's over its all of its moving average, you can see, and that's a sign of momentum. And as interest rates are going up, I think that helps financial companies. Um, Visa, hmm, I just think inflation, it helped. Visa was helped by inflation because as prices go up, then they make more transactions. So there's a higher transaction volume. So that's why Visa might have done well during this inflationary time. Waste management. This is stock that is it's right here. It's like halfway in between overbought and oversold. So it's done. Can't do anything there. And Amgen's oversold, like with a lot of the healthcare stocks. Let's look at the other ones. Chipotle is at the bottom. It's over. It's almost oversold. Just a little bit more, and it'll be oversold. All right. So when you're thinking about buying a stock, and putting some money into it, you want to wait for it to go down to one of these trading ranges and to be oversold. Because that's usually the opposite of what everyone else is doing at the time. All right, this is an example of Tractor Supply. You can see it's another example of a stock that's at its 200-day moving average, which is support. It's oversold, and it's still on an uptrend. So let's see how that goes over time. All right, so that was fun. Let's look at some of the stories in Yahoo Finance. Okay, wow, this is huge news right here. NVIDIA to replace Intel in Dow Industrial Average. Um, okay, so that's the news. NVIDIA, it's probably going to go up on that. NVIDIA, Intel's going to go down. And the reason why the company that runs this Dow Jones Industrial Average Index, um, they're really good at picking companies that are good fundamentally. And whenever you see a stock, a, an index, 30 stocks choosing one of the stocks we're following, that's huge. And Intel is going to go down based on that because there's going to be a lot of selling. People are going to say, well, there's Dow Jones people that make that index. They're smarter than me. If they are selling Intel, number one, there's going to be a lot of forced selling from indexes and funds that track that index. And number two, there's a lot of people like you and me saying, if they're getting rid of Intel, maybe I should too, because fundamentally, actually, we've said for years now that Intel is a poor company with a lot of challenges. But that's just another bonus for NVIDIA. It's going to be one of the Dow 30, which is going to give it a lot more. Um, it, it's going to be more in your face than it was before. So look at some more thing. Look at some more news. Let's see. Okay. Okay, DJT stock slumps 20% over the last 5 days ahead of Trump-Harris election. Let's look at that news story. Um, I think DJT is like the worst fundamental stock I've ever seen. Um, it's losing money like crazy. It's losses, and there's no end in sight. And there's only one. I mean, it has competition of Twitter, and the only bonus it has is it has the president Trump that is um, behind it. So Trump might use that platform during his presidency, which would help the stock. But right now, if you look at DJT, if we look at the fundamentals of DJT, it's just not even close to plenty. It has no PE ratio, no no fundamental anything. Let's look at the earnings projections for this stock. It's down 13% today. So I'm unavailable because they don't have earnings. So let's look at Yahoo Finance and see if we get DJT, the information on that. A lot of times, whenever you don't find the fundamentals or earnings estimates, you can't invest in it. Warren Buffett said once, if you can't buy a stock, you want to buy stocks that you can hold for 10 or 20 or more years. If you can't buy a stock for 20 years, don't buy it for 10 minutes. I think that's what he said. So let's look at this is like one of the worst charts I've ever seen. Let's look at statistics. Trailing PE missing. Enterprise value $7 billion. Let's look at we have nothing for a PE, nothing for PEG, they don't have earnings. Um, Profit margin, zero, negative, negative, negative. This is just a nightmare. Debt, current debt is not that bad. Total debt is 1 billion. Total cash, say the half a billion in debt. Example of a stock you don't, um, and you want for 10 years. All right, so that's a good little news story. I'm glad we went through that. Let's look at some more news just for fun. It's taking its time. Okay, so look at some more news. Okay, this is an example of we have in the streaming wars, we have a couple of different players. We have Netflix, we have Roku, we have Hulu and Disney. Disney owns Hulu, most of it. And so Disney is in a big competition, and Comcast, I guess, is streaming also. Netflix has the advantage right now because they were first mover and they have most market share right now. Um, let's look at Netflix. This is actually a really good stock, a growth stock. A lot of companies, a lot of mutual funds don't own this right now. But if we look at the actual fundamentals on Netflix, they're growing at like 20%. Let's look at their PE ratio is 31. That's pretty rich. They've always traded a rich PE, but they're growing. Let's look at what they're growing. Their PEG ratio is 1.5. So divide the current price by 1.5 and you'll get around 400 is their probably their fair value. But they're growing at 30% or so, it seems, or 20%. So you can see their return on assets is great. Equity is great. Return on equity is 34. We have profit margin of 20, all above what I'm looking for. And earnings growth, 40%. So they're doing like super good. Let's look at their um, NFLX. So according to Yahoo Finance, they are the best streaming company out there, and they have number one position there. So let's look at their earnings projections. Okay, you can see, I could just tell by this graph, they're growing like 15 or 20%. Let's do the math on that just for fun, just so we can see. From last year, from 25, from this year to next year, 20, they're growing at 20% from this year to next year. From now, the year after that, it's 19, 20%. Okay, so they're growing around 20%, and their PE is 31. So if we divide 30 by 20, that's where you get to 1.5 PEG ratio that Yahoo Finance mentioned. So that was a good little exercise, but that tells you where's the PEG ratio? Right there, 1.5. So they are growing at 20% a year, and they're the best in their class. So this is an example of a stock. I will set a notification when the price gets down to 1.5. So 756 divided by 1.5. When a price gets down to $504, that's fairly valued there, and I would start buying some there. If it goes below that, every 20% it goes down and buy a little bit more. So that's my little approach to buying and selling stocks. Um, Let me see. So this stock goes up and down based on its subscriber additions. There are times when there aren't as many subscribers in a quarter, and that's varying. So if you have a time when they miss their estimates, they'll go down 20%. And their stock price, you look at this chart, it's full of up down 20%. And you have to be understanding of that whenever you get into the stock. And right now I'm not going to buy the stock, when it's an all-time high. And let's look at like a 5-year chart of this. You can see this downtrend in 2022. This was when all the tech stocks were selling off when they started raising interest rates. Um, so if you see, look at this down here. It went the whole way down in 2022. It went to probably the whole way down to $500 a share. That's the PEG ratio of 1. So that is a good example of in the worst of times, the great stocks trade to a PEG ratio of 1, and that's when you know it's kind of bottoming out. All right, so that was a good little exercise. I think that's it for this time. I hope you had fun on this talk. I hope you have good investing next week, and see you all next time.